I would like to introduce to you Professor Abraham, my good friend and colleague. In the course of his academic career, Professor Abraham, AB as I call him, has worn many hats. He has been a teacher, a scholar, a fund manager, and an advisor to fund managers. He has done this in many parts of the world, in the Middle East, in India, and in the United States.
Professor Badrinath just mentioned we're going to talk about the basics of options today. The Oxford English Dictionary defines an option as the freedom or right to make a choice. Financial options reflect this definition exactly. The choice specifically refers to the right, but not the obligation to buy or sell some specified asset, such as gold or shares, at an agreed-to price at an agreed-to date in the future. The key feature to focus on is the right, but not the obligation. As an illustration, let us take a hypothetical example. Suppose you wish to take a beach vacation in Goa at the end of the month, but are not sure if the boss will approve your vacation. If you purchase the plane tickets today, they will cost rupees 1,000 and will be non-refundable. If you purchase the ticket at the last minute, the same ticket will of course cost more, say rupees 2,000. So you have a choice to make. Should you buy the ticket now for rupees 1,000 and risk losing it if your leave is not sanctioned? Or should you wait till the end of the month and if your leave is sanctioned, pay the 2,000? Just imagine that you could extract a promise from the airline that for a payment of rupees 100 today, you have the right, but not the obligation, to purchase the ticket at the last minute for rupees 1,200. Thus, your outlay today will be 100 rupees, and you can think of it as a down payment towards a possible future purchase. At the end of the month, if your leave is not sanctioned, the most you stand to lose is the 100 paid for the option. If, however, your leave is sanctioned, you can purchase the ticket for an additional payment of 1,200. Relating it to options, in options jargon, you would choose to exercise your option contingent on whether your leave is sanctioned or not. There are two kinds of options: a call option that gives the right to buy the underlying asset, and the other is a put option that gives the right to sell the underlying asset. An option, whether it is a call or a put, has to be purchased from another party who is willing to sell the option. This involves paying the price or the premium demanded by the seller of the option. In terms of the example above, the rupees 100 you would be paying upfront is the premium on a call option that gives you the right to purchase a ticket or exercise the call option for rupees 1,200 should your leave be sanctioned. Digging a little deeper, specifically, a call option gives the buyer of the option the right but not the obligation to purchase the underlying asset at a specified price, called the exercise price, at or before a certain future date, called the expiration date. To obtain this right, the buyer pays the seller of the option the premium upfront today. Let us take a specific example. On September 24, a rupees 800 exercise price call option on Asian Paints that expire on October 31 was trading on the NSE at a premium of rupees 44. The price of the underlying Asian Paints share on that date was rupees 1767. If you were to buy this call option on September 24th, you would pay rupees 44 to the option seller and thus have the right to buy one share of Asian Paints on or before 31 by paying rupees 1,800, regardless of what the price of Asian Paint shares are on that date. Let us now examine the circumstances under which you would exercise the option that you now have. You are clearly going to wait till October 31 and see what the price of Asian Paints turns out to be. If the price of Asian Paints shares rises to above 1800, it will be in your interest to exercise the call option. Say, for example, if the share price goes to rupees 1850, you would exercise the option, i.e., you would pay rupees 1800 and acquire one share, which you could then sell at the current price of rupees 1850. Your payoff would be rupees 50. Taking into account the 44 you paid to purchase the option, your net profit would be 6 rupees. On the other hand, if the price remains at 1800 or less, you would simply tear up and throw away the option, incurring a loss of rupees 44. What if the price of the share settles at rupees 1820? Again, it is in your interest to exercise. Your payoff would be 20, which will partly pay for the 44 you paid up front. The price of Asian Paints must exceed the exercise price by more than rupees 44 before the buyer begins to make a positive profit. Graphically, the payoff to the call option buyer looks something like this. In the deep dive on this topic, you can see a tabular representation of the payoff and profits in greater detail. Who would be potential buyers of call options? Presumably, these are investors who expect the price of Asian Paints shares to appreciate in the future. Investing in call options thus can be viewed as a bullish investment in the stock. Note that the worst that can happen to the call option buyer is that he loses his initial investment of rupees 44, but has no upper limit on his potential gain. Your loss is limited to that amount, while your gain depends on how far upwards the shares move. Who would sell these call options? The option seller's predicament is just the opposite. The most he/she can make is the rupees 44. You would have to be very confident that the stock price is not going to rise in order to make this bet. Writing or selling options can therefore be very risky. Turning now to put options. Purchasing a put option gives the buyer the right but not the obligation to sell the underlying asset at the exercise price on or before the expiration date. Again, let us take a concrete example. On September 24th, a put with an exercise price of rupees 1700 expiring on October 31 was trading at rupees 21. The price of the underlying Asian Paints share was rupees 1767. Assuming you had purchased this put option, let us examine the circumstances under which you would exercise this option. You would wait till October 31 and observe what Asian Paints shares value turn out to be. If the share price turns out to be less than 1700, it would be in your interest to exercise the option. Say the price of Asian Paints shares declines to rupees 1650. You would simply purchase a share from the market at 1650 and put it to the option seller for rupees 1700, earning a rupees 50 payoff. Adjusted for the 21 you paid to purchase the option, your net profits would be rupees 29. We can see here that put holders will benefit when the asset price declines. The payoff to a put holder can be seen to look something like this. The worst that can happen to a put buyer is the loss of the initial investment of rupees 21. And the best that can happen is if Asian Paints goes bankrupt and the share price goes to zero. From the put writer's perspective, the most he can make is 21 rupees, but could stand to lose a considerable amount if share prices were to decline significantly. Potential buyers of puts are either investors who are bearish on the stock or those that are seeking an insurance cover on their underlying holding of the share. Option trading is normally conducted on organized exchanges such as the NSE, which provide electronic platforms that facilitate trading. Buyers and sellers can enter the prices at which they are willing to transact. The electronic platform then matches buyers and sellers if there is price agreement. Option buyers simply have to pay the premium, but option sellers or writers are required to post a good faith deposit or margin with the exchange to ensure they are good for any losses they incur. Options trade on a variety of different strike prices and maturity date. Options provide powerful means to invest in financial markets. For example, as we saw with the Asian Paints case, a mere 44 rupees investment in a call option controls one share, whereas buying the underlying stock itself requires an investment of rupees 1767. In a related topic, we will see how these calls and put options can be combined in imaginative ways to achieve different future objectives.
Thank you, AB, for generously volunteering your time and sharing your insights with our Pi audience.